Morgan Stanley is out with its latest large cap bank upgrades and downgrades heading into 2025. Joining us now is Betsy Graseck, Global Head of Banks and Diversified Finance Research at Morgan Stanley. Good to have you on. Good
Thanks for having me here.
Let's start with, did anything change based on the election outcome for how you're monitoring things like this?
Well, look, the election outcome does have an impact on how we think things are going to roll from here, right?
So it did matter.
Yes.
Yeah.
Yes. And especially going into the election, I don't think the expectation was there was going to be a Republican sweep.
Right.
So the R sweep, definitely adds a layer of differential relative to where we are today. That does, drive some outlook changes.
I've almost seen across the board that when they look for the Trump trade, financials are almost always included. We've also had guests in that said that it's going to be the dawn of a new age for community banking because of less regulation. Do you view that? Is that true, or who does it benefit the most, and what are your favorites?
Okay, so I'm the U.S. large cap bank analyst, so I'm going to leave community.
You don't
banks
care about community.
Well, I don't. No, I care, but I'm not going to.
Is it across the board going to help the financial sector, Trump?
Can I step back and just say
Yeah.
that for regulation, I think we all know that at least for financials, I think we will see a stabilization of regulation. Okay. And for the large cap banks, and that's for the large cap banks, the mid cap banks, there might be a couple of changes based on, stemming from what happened with First Republic and Silicon Valley Bank Group. But beyond that, we're really looking for stabilization in large cap bank regulation. And that's a positive because elimination of a negative is a good thing.
Yes. So with all that, when you take that into, excuse me, I don't know, I think I have GERD. I don't think this is, but with all that in mind, who does it benefit the most? Who are your favorites? What have you changed based on your past outlooks?
So I would say the three reasons why we are overweight the U.S. large cap banks is number one, capital markets rebound, number two, regulation stabilizing, and number three is quantitative tightening ending in 2025. Now, on regulation front, it's a positive for everyone to understand that we're going to have stabilization as opposed to creeping tougher, not sure how tough. Right, so everybody benefits from that. Mm-hmm. I will say that in our outlook, we indicated that regulation stabilizing is most positive for Citigroup, for Wells Fargo, for Goldman Sachs, and the reasons are different. Citi has a significant amount of excess capital. Understanding that rules are not going to get tougher gives them more flexibility to begin buying back stock or stepping up buybacks, which I know they discussed at a conference this week. So, and that's really powerful for that stock because it is trading below book.
Mm-hmm. You did upgrade, BK, State Street, Northern Trust. You downgraded Bank American Regions, though.
Mm-hmm. Yes.
There's a reason. Why do you like three and not the other two?
Okay, so Joe, this gets into.
Is it too much in the weeds?
Okay. No, not at all.
Okay.
It gets into something else about the election. So the election brings with it, and the R sweep brings with it, in our opinion, regulation stabilization. But it also brings with it tariffs and immigration change. Right? So when I think about how that's going to roll in 2025, obviously it's very uncertain, right? We're not sure how tariffs and immigration is going to impact the economy. So we have a base case, a bull case, and a bear case.
Okay.
And in our base case, we've got modest impact. Bear case is more negative impact, and bull case is very minimal impact, right?
I see.
And the challenge is because of the tariffs and the immigration, I have an equal probability going into 2025 for bull, bear, and base. It's the first time I've been equal probability going in. And so how do I set up for that? I want to have overweight stocks that can do well in the base case and bull case, which comes with capital market rebound, significant, very significant capital market rebound. And then B of A doesn't have as much skew as Goldman, Citi, and others. So that's where they got the downgrade. But then on bear case, where the tariffs and immigration comes with some pressure on the economy in the second half, I want a little less exposure to credit, and that's why regions got pulled down.
Okay, so they're not. I mean, even the downgrades are only to equal weight at this point, so we understand that. That's good. How far do you have to travel to come down here? You're in town, right?
Oh well, my next gig is across the road, so I'm good.
Okay, good.
Yeah,
very good.
I would just like to say, if I have a second, the capital markets rebound piece of the equation here is really important. We were at 30-year lows in terms of M&A, equity capital markets, debt capital markets relative to GDP.
See, now he's interested. Yeah.
Oh, yeah?
Capital markets.
I was interested the whole time. But
I know. But you love capital markets.
I'm fascinated by it. I am.
Very good.
Well, it is up and to the right. It is game on for 2025 because we have been coming off of this extremely low period of activity relative to GDP. 30-year lows in just 2023. So we're just pulling off of it. Now we've had a couple of good quarters, but even 4Q annualized, equity capital markets and M&A is half cycle average. So this is where the juice is, especially in the first half of 25.